Silver isn't surging, and it isn't collapsing, but something far more important just happened. In the last 24 hours, a $12 trillion liquidity shift quietly moved through global capital markets, and silver is sitting directly in its path. The price looks stable near $76, but registered inventories are tightening, lease rates are flashing stress, and premiums in Asia are widening again. This isn't a volatility story, it's a positioning story. And the next 72 hours could confirm whether silver is entering structural repricing or another controlled reset. Let's break down what the chart shows and what the structure reveals. The quiet, $12 trillion rotation. Silver was trading near $76, and at first glance, nothing looked unusual. The daily chart showed consolidation. Volatility had cooled compared to previous swings. Financial headlines were focused on inflation data and central bank guidance. For many casual observers, it appeared to be just another sideways week in commodities. But beneath that calm surface, capital was moving. Over the past several sessions, global markets experienced a liquidity rotation estimated in the trillions of dollars. This was not a single transaction or a secret agreement. It was a structural reallocation. Large institutions adjusting exposure across bonds, equities, currencies, and commodities in response to changing macro signals. When analysts referenced a $12 trillion shift, they were describing the size of capital pools that were repositioning, not a single hidden deal. These rotations matter because silver does not move in isolation. It sits at the intersection of monetary policy, industrial demand, currency flows, and risk appetite. When large capital pools rebalance, silver often reacts later, not immediately, because it is both a monetary metal and an industrial input. In simple terms, the price may lag the positioning. Bond yields had been volatile. Inflation expectations were adjusting. Real yields, which reflect inflation-adjusted interest rates, were fluctuating within a narrow but sensitive range. Meanwhile, the US dollar index had strengthened slightly, but not decisively. These cross-currents created uncertainty, and uncertainty tends to produce repositioning. Institutional capital does not typically chase headlines. It reallocates based on risk models, correlations, and forward expectations. If bond volatility rises and equity valuations remain stretched, capital often diversifies into commodities as a hedge. That does not mean prices must surge immediately. It means exposure begins to shift. Silver's structure showed subtle signs of this. Open interest in futures remained elevated relative to registered inventory levels. The ratio was not unprecedented, but it was notable. When open interest remains high while registered supply remains tight, it creates a structural tension. That tension does not automatically translate into price movement. It simply means that positioning is dense. At the same time, lease rates had risen compared to historical norms. Lease rates reflect the cost of borrowing physical silver in the short term. When rates increase, it can indicate tighter availability in certain segments of the market. Analysts are careful not to overstate this signal. Lease rate spikes can normalize quickly, but in context, they contribute to a broader picture. Regional premium differences also drew attention. In parts of Asia, physical premiums were slightly wider than Western exchange pricing suggested. These differences fluctuate frequently due to logistics, taxes, and local demand. However, persistent gaps can indicate regional demand strength relative to futures pricing. None of these signals alone prove a structural shift. Together, they suggest monitoring. The key point is that silver's price stability does not necessarily mean inactivity beneath the surface. Financial markets are layered. Visible price action is only one layer. Beneath it are flows, hedges, deliveries, and inventory changes. Analysts who follow silver closely focus on ratios more than headlines. They watch the relationship between registered inventory and open interest. They observe how much metal is standing for delivery versus rolling contracts forward. They compare exchange-traded fund flows with futures positioning. These structural elements often shift before price trends become obvious. The broader macro backdrop also matters. Inflation data was approaching. Consumer price index releases tend to influence real yield expectations. If inflation prints higher than expected while nominal yields remain stable, real yields fall. Historically, lower real yields can support precious metals. If inflation surprises lower and yields rise, the opposite dynamic can occur. In this environment, institutions adjust exposure ahead of the data, not after it. That is part of the current rotation story. The US dollar also plays a central role. Silver often moves inversely to dollar strength, though not perfectly. If the dollar continues to stabilize or weaken, it can reduce pressure on commodity pricing. If it strengthens sharply, it can create headwinds. Therefore, the dollar index becomes a confirmation variable rather than a standalone signal. What makes the current moment interesting is the convergence of factors within a narrow time window. Delivery cycles are approaching, inflation data is scheduled, bond volatility remains elevated compared to earlier in the year, and capital allocation models are adjusting to shifting correlations between stocks and bonds. This convergence creates a 72-hour setup. not because something dramatic must happen, but because multiple variables are aligning simultaneously. Serious investors avoid dramatic language. They do not assume that consolidation equals accumulation, or that imbalance guarantees repricing. Instead, they treat structural signals as probabilities. Right now, silver's structure reflects three observable characteristics. First, positioning remains dense relative to registered supply. Second, borrowing costs for physical metal have shown periodic firmness. Third, regional demand signals are not fully synchronized with futures pricing. None of these elements confirm a breakout, but together, they justify attention. The $12 trillion rotation narrative is not about secrecy, it is about scale. When large capital pools rebalance, secondary markets like silver can experience delayed effects. Institutional flows are gradual. They accumulate exposure over time. Price often responds after positioning is established. That is why the current calm is significant. In highly speculative phases, silver moves sharply and publicly. In structural phases, it tightens quietly. Volatility compresses. Ratios matter more than headlines. Delivery strength becomes more relevant than daily candles. The coming days will offer data points. If delivery participation increases while inventories remain stable or decline modestly, structural tightness strengthens. If open interest contracts meaningfully without inventory change, pressure may ease. If real yields move sharply in either direction, metals will likely respond accordingly. Investors who approach silver analytically focus on confirmation rather than anticipation. They understand that imbalance can persist without resolution. They recognize that capital rotations unfold over weeks, not minutes. For now, the story is not about a surge or a collapse. It is about alignment. Large capital pools are repositioning across global markets. Silver's structure shows mild but noticeable tension. Macro data is approaching, and delivery metrics will soon update. The next move may not be explosive, but the structure suggests it will be informative. The structural clock beneath the price. Silver continued to trade within a narrow range, and the chart gave no clear signal of urgency. Daily candles were modest. Momentum indicators were neutral. News coverage was limited. To an outside observer, the market appeared balanced. Yet beneath that balance, time was becoming a factor. Every futures market operates on a clock. Contracts approach delivery periods. Participants decide whether to roll forward or stand for delivery. Open interest expands or contracts. These processes are mechanical, but they reveal behavior, and behavior often precedes price. As the next delivery window approached, analysts began examining participation patterns. They were not looking for drama. They were looking for shifts in proportion. How many contracts would be rolled? How many would stand? Would open interest decline sharply, or would it remain firm into notice periods? These ratios matter because they reflect intent. If a high percentage of contracts roll forward early, it suggests most participants are purely financial. If more contracts remain open closer to delivery, it suggests stronger interest in settlement, or at least in maintaining exposure through the deadline. That does not automatically mean physical shortages. It means positioning is holding steady rather than dispersing. Silver's recent structure showed something subtle. Open interest had not collapsed despite consolidation in price. In many past cycles, sideways movement was accompanied by a visible reduction in exposure. This time, positioning appeared relatively stable. That stability can indicate confidence, hedging necessity, or strategic patience. At the same time, exchange inventory reports showed gradual adjustments rather than dramatic withdrawals. Registered stocks were not collapsing, but they were not expanding meaningfully either. When inventories remain steady while open interest remains elevated, the ratio between the two becomes the focus. Ratios create tension because they define optionality. If inventories rise while open interest falls, pressure relaxes. If inventories stagnate while open interest holds firm, the structure tightens incrementally. Tightening does not guarantee repricing. It simply reduces flexibility within the system. The concept is similar to a coiled spring, though in markets the coil can remain compressed longer than expected. Another layer of the structural clock involves volatility compression. When implied volatility narrows and daily ranges shrink, markets often prepare for expansion. This is not a prediction of direction. It is an observation of rhythm. Periods of low volatility frequently precede directional moves because positioning builds quietly during calm phases. Silver's volatility profile had compressed relative to earlier swings. That compression coincided with steady open interest and stable inventories. In isolation, none of these signals are decisive. Together, they suggest that the market is storing energy. Meanwhile, macro correlations were shifting. Equity markets were experiencing selective weakness in certain sectors. Bond yields were fluctuating within a tight band. Commodity indices showed mixed performance. In such an environment, institutional models reevaluate correlation assumptions. If stocks and bonds move together unexpectedly, diversification strategies adapt. Commodities can become a balancing component in those recalibrations. Silver occupies a unique role because it reflects both industrial and monetary demand. If industrial forecasts remain steady while monetary hedging demand increases, silver can attract incremental allocation even without dramatic headlines. Importantly, analysts avoid assuming causation without evidence. A stable open interest level does not prove accumulation. A steady inventory level does not prove scarcity. However, when positioning remains firm during consolidation, it suggests participants are not exiting aggressively. That behavior contrasts with panic-driven markets where exposure evaporates quickly. The structural clock also involves global trading sessions. Silver trades across time zones and liquidity conditions vary. Asian session premiums had shown moderate firmness relative to Western futures pricing. These differences can emerge from logistical constraints or local demand preferences. Persistent premiums are more significant than temporary ones. Therefore, analysts monitor whether these gaps widen, narrow, or stabilize. If regional premiums expand while futures remain flat, it can indicate localized demand strength. If premiums narrow quickly, it may suggest balanced flows. The direction of these gaps over several sessions often provides clearer information than any single data point. Another factor under review was exchange-traded fund flows. ETF inflows and outflows reflect investor appetite for silver exposure without direct futures participation. In recent sessions, flows were relatively muted. That neutrality implies neither widespread retail enthusiasm nor mass liquidation. Institutional positioning can continue quietly even when ETF flows appear calm. This reinforces a broader point. Silence in headlines does not equal inactivity in structure. As the delivery window neared, three measurable variables became central. First, the percentage of contracts remaining open near first notice day. Second, the change in registered inventory relative to that open interest. Third, the behavior of lease rates and regional premiums during that period. If open interest declines sharply while inventories remain constant, structural pressure eases. If open interest holds while inventories draw down modestly, tension builds gradually. If both remain stable, the market may simply continue consolidating. This is why the coming sessions matter. Not because a dramatic move is guaranteed, but because alignment between positioning and inventory will clarify direction. The structural clock does not tick loudly. It advances quietly through reports and ratios. Serious participants follow these updates methodically. They understand that price is often the final variable to react. For now, silver's structure suggests patience rather than urgency. Positioning has not dispersed, inventories have not expanded decisively, volatility has compressed, delivery participation will soon provide more clarity. Markets do not always reward anticipation. They reward observation. If the current alignment persists through the delivery cycle, the probability of directional expansion increases. If positioning unwinds before notice periods, the system relaxes and consolidation may continue. In this phase, the difference between speculation and analysis becomes clear. Speculation demands immediate conclusions. Analysis tracks the clock. Silver's clock is approaching a checkpoint. The data over the next several sessions will determine whether this is merely a pause within a broader range or the beginning of a more defined structural shift. For now, the surface remains calm, but beneath it, timing is becoming the dominant variable. The confirmation layer. What must align next? By the time silver moved into the heart of the delivery cycle, the conversation had shifted from speculation to verification. The earlier discussion was about structure. Now the focus became confirmation. Markets can hold tension for long periods, but eventually data forces interpretation. Silver remained near the same price band. The absence of dramatic movement created two opposing narratives. One group saw stability as evidence that nothing meaningful was developing. Another group viewed stability as a sign that positioning was firm. Neither interpretation was automatically correct. Only alignment between data sets could resolve the debate. The first layer of confirmation involved real yields. Silver often responds more to inflation-adjusted yields than to headline inflation alone. If nominal yields rise, but inflation expectations rise faster, real yields fall. Historically, falling real yields reduce the opportunity cost of holding non-yielding assets like silver. If real yields rise, metals often face pressure. Therefore, analysts began monitoring bond market behavior more closely than daily silver candles. If real yields continued to soften while silver held its range, that combination would suggest underlying support. If real yields strengthened and silver remained stable, that would imply resilience. But if real yields rose sharply and silver began to weaken, the structural tension described earlier might unwind instead of expand. The second layer involved currency dynamics. The US dollar index had been firm but not decisive. Silver's inverse relationship with the dollar is not mechanical, yet it remains influential. If the dollar rallied aggressively while silver refused to break lower, it would indicate relative strength. If both the dollar and real yield strengthened simultaneously, silver would face a more difficult environment. This is why analysts often speak about clusters rather than single indicators. Confirmation requires more than one variable pointing in the same direction. The third layer was participation quality. Open interest numbers alone do not reveal intent. What matters is how those numbers behave during stress. If price tests the lower boundary of a range and open interest drops quickly, that suggests longs are exiting. If price tests the same boundary and open interest holds steady, it implies conviction among participants. During recent sessions, minor dips had not produced aggressive liquidation. That observation did not confirm accumulation, but it suggested the absence of panic. Markets often reveal their underlying tone not during rallies, but during pullbacks. The fourth layer was physical flow data. Inventory reports showed incremental movement rather than abrupt changes. The question was whether that incremental movement would accelerate. A sudden surge in registered inventory could ease structural concerns. A noticeable drawdown during steady open interest could intensify them. However, analysts avoided dramatic assumptions because physical markets operate with logistical constraints. Shipments and classifications change methodically. Regional premiums continued to fluctuate within a modest range. If those premiums widened consistently over several sessions, it would reinforce the idea of localized demand strength. If they narrowed quickly, it would suggest balance. The key word in this phase was alignment. For a structural shift to gain credibility, several elements must move together. Real yields stabilizing or declining, dollar strength plateauing, Yodcint, open interest remaining firm into delivery, inventory not expanding materially, premium spreads not collapsing. If these elements align, probability increases that the next directional move will reflect structural positioning rather than short-term speculation. If they do not align, the system resets and consolidation continues. This approach avoids exaggerated conclusions. It treats the market as a system of interacting variables rather than a headline-driven narrative. There's also a behavioral dimension to confirmation. Institutional capital does not typically chase price spikes. It builds exposure gradually and increases allocation when structural conditions validate the thesis. Therefore, analysts look for steady volume rather than sudden bursts. Controlled accumulation often appears boring on a chart. It lacks dramatic candles. It shows persistence instead of volatility. In recent sessions, silver's volume profile had been steady but not explosive. That steadiness suggested engagement without urgency. If volume expanded significantly while price held support, that would represent a stronger confirmation signal than a thin rally. The broader macro environment also contributed to the confirmation layer. Equity valuations remained sensitive to interest rate expectations. Bond markets were reacting to inflation data with measured adjustments. Commodity indices were mixed. In such an environment, silver's ability to hold range without external pressure becomes informative. Markets often test conviction before rewarding it. A range-bound phase can frustrate participants and cause weaker hands to exit. If positioning remains firm through that phase, the subsequent move often carries greater weight. The concept is not dramatic. It is structural. Silver's current phase is not about predicting a surge. It is about observing whether multiple variables converge. If real yields ease, the dollar stabilizes, delivery participation remains steady, and inventories do not expand, the structure tilts toward tightening. If one or more of these variables move against silver decisively, tension dissipates. Serious investors recognize that confirmation takes patience. They avoid labeling every sideways period as accumulation. They wait for measurable alignment. As the week progressed, the confirmation checklist remained incomplete but active. No single metric invalidated the structural thesis. No single metric fully confirmed it either. That neutrality is not weakness, it is transition. Markets rarely announce their next phase clearly. They reveal it through consistency across indicators, and when enough variables move together, direction becomes evident. For now, silver remained in observation mode. The surface chart showed calm. Beneath it, analysts tracked real yields, currency strength, open interest behavior, inventory stability, and premium spreads. The next development will not be defined by emotion. It will be defined by alignment. And alignment, once visible, tends to matter more than any headline. The behavioral edge and the decision framework. By the time the structural signals, confirmation layers, and delivery data were reviewed, one reality became clear. Silver was not sending a loud message. It was sending a quiet one. And quiet markets often test discipline more than volatile ones. At this stage, the question was no longer whether silver would surge or decline immediately. The more important question became how serious participants interpret a market that shows compression, steady positioning, and macro uncertainty at the same time. The answer lies in behavior. Professional capital allocators rarely react to a single data release. They operate within frameworks. These frameworks define how much exposure to hold, when to adjust, and which signals require action versus observation. In silver's current environment, three behavioral approaches were visible. The first approach was reactive. This group focused primarily on daily price movement. If silver dipped, they reduced exposure. If it bounced, they increased exposure. This method depends heavily on short-term volatility and often ignores structural metrics. It can work during strong trends, but during compression phases, it leads to frequent adjustments with limited clarity. The second approach was conditional. These participants identified confirmation thresholds in advance. For example, they might increase exposure only if real yields declined for several sessions while open interest remained stable. Or they might reduce exposure if inventories expanded sharply during a delivery window. This approach relies on predefined conditions rather than emotion. The third approach was structural. These participants evaluated silver as part of a broader macro allocation. They did not attempt to predict each price fluctuation. Instead, they examined whether the long-term supply-demand framework and macro environment justified maintaining a strategic allocation. Delivery metrics, premium spreads, and yield movements influence timing, but not necessarily conviction. Currently, silver's structure favored conditional and structural frameworks over reactive ones. Volatility compression tends to frustrate reactive traders because price does not reward quick decisions. However, for longer-term allocators, compression provides information. It indicates that neither side of the market has gained decisive control. This balance creates an important checkpoint. If silver breaks above its consolidation range while structural variables align, meaning inventories do not expand, real yields remain supportive, and open interest does not collapse, that move carries stronger credibility. It suggests the system absorbed pressure and resolved higher. If silver breaks below its range while open interest declines sharply and inventories rise, the system relaxes. That outcome suggests positioning was not as firm as previously observed. In both cases, the decision framework remains analytical. Another behavioral component involves correlation awareness. During recent years, traditional diversification between stocks and bonds has occasionally weakened. When correlations shift unexpectedly, commodities often become a recalibration tool. Silver's role in such recalibrations depends not only on its price, but also on its liquidity profile and industrial linkage. Industrial demand projections remain steady. Monetary demand fluctuates with macro conditions. If capital allocators anticipate prolonged inflation variability or currency volatility, maintaining exposure to tangible assets can serve as a hedge. That does not require dramatic price movement. It requires stability within a strategic framework. The structural tension described in earlier sections does not guarantee repricing. It does, however, define boundaries. Within those boundaries, investors monitor 5 variables consistently. First, real yield direction over multiple sessions rather than a single print. Second, dollar index stability relative to recent highs and lows. Third, delivery participation ratios compared to historical averages. Fourth, registered inventory changes relative to open interest. Fifth, regional premium persistence rather than isolated spikes. If 3 or more of these variables align in one direction, probability shifts meaningfully. Until then, discipline outweighs anticipation. There's also a psychological dimension worth noting. Markets often move most decisively after participants lose interest. Extended consolidation can reduce media coverage and retail participation. When attention fades, but structure remains intact, subsequent moves tend to surprise those who disengage too early. Silver's current phase carries elements of that pattern. Price action is not dramatic. Headlines are limited. Yet structural variables continue to update daily. The absence of noise should not be mistaken for absence of development. However, analysis must remain balanced. Structural tension can dissolve quietly. If delivery metrics show minimal participation and inventories expand modestly, the market may simply continue its range. In that case, patience remains appropriate. The disciplined approach is not about predicting a breakout. It is about preparing for confirmation. When confirmation arrives, whether upward or downward, it will likely follow alignment across yields, currency strength, positioning, and inventory behavior. That alignment often appears gradually before becoming visible on a chart. For now, silver occupies a transition zone. It is not in a speculative surge. It is not in a panic unwind. It is in a structural evaluation phase. Large capital rotations are occurring globally. Delivery metrics are approaching checkpoints. Macro data continues to influence real yield expectations. The system is not silent. It is measured. In such an environment, the advantage belongs to those who track structure consistently rather than react emotionally. Silver's next directional phase will not begin with a headline. It will begin with alignment. And alignment, once established, tends to move markets with more authority than volatility alone.